Hello, and thank you for joining this Magellan update. I'm Amy Krizanovic, Head of ESG, and today I'm joined by David Costello, Portfolio Manager in the Infrastructure team.
Thanks, Amy. It's great to be here.
So today we're going to be discussing extreme weather events and energy transition for the infrastructure portfolio. Sitting here in Australia, we've experienced firsthand the devastating impacts of extreme weather events, whether that be fires, floods or storms. A recent example from this year were the Victorian storms, where we saw over 600,000 homes and businesses lose power. The operator AusNet was also questioned in terms of their role, and it resulted in some fines and also a public apology from the operator. So this is a risk that we need to think about in the infrastructure portfolio and can have links back to social licence to operate or financial risks. So maybe now turning to the US, which is where more of our utilities strategies invested. Nearly 100 million Americans have experienced extreme temperatures, with some major cities declaring heat emergencies. Some climate scientists working with the World Weather Attribution Group said heat waves that have hit the US and Mexico earlier this month were made 35 times more likely due to climate risk. So I'm looking forward to discussing with you today how we think about these extreme weather events within the infrastructure portfolio.
Well, Amy, when we think about the impact of physical risks, we are guided by an assessment of the materiality of their impact to cash flows. That's our North Star here. And I'd suggest, Amy, that it's instructive when we're framing those impacts to cash flows to think about physical risks along two dimensions. The first relates to a company's vulnerability to physical risks, both in terms of environmental characteristics, but also in financial terms. And the second dimension that we think shapes their physical risk exposure is their implementation of mitigation strategies, their ability to curtail that inherent environmental vulnerability. Now, crucially, that framework, I think, plays to Magellan's strengths, our deep fundamental research and our deep domain expertise and our access to the foremost industry experts, because we'll see that the correct course of action from an investment perspective in these scenarios often turns on very fine subtleties and nuances.
So maybe, David, if you could just talk to some examples of where companies have made it into the infrastructure portfolio, or maybe where you wouldn't invest related to this physical climate risk.
Certainly. Amy, you get an interesting case study when you compare the divergent investment decisions that we made in response to two catastrophic wildfires involving holdings in various Magellan infrastructure strategies. So the first incident involved a catastrophic wildfire in the service territory of PG&E, a regulated electric utility in the north of California. And the second, more recently, involved Xcel Energy and their Southwest Public Service Company subsidiary in Texas. Now, notably, in PG&E's case, we determined that the risks to cash flows were sufficiently material that it warranted exiting our position in that company to preserve capital for unit holders. By contrast, in Xcel's case, we actually took the opportunity to increase our position in the company in the aftermath of the fire. Now, going back to the framework that I described earlier, looking at PG&E, the company's inherent vulnerability to wildfires are readily apparent from an environmental perspective. The area that the company serves is heavily forested and is typically subject to dry, arid conditions. But those conditions are interspersed with periods of intense rainfall that drive rapid growth in vegetation. Now, of course, when that vegetation subsequently dries out, when the arid conditions return, it creates significant fuel for wildfires. And those wildfires can quickly grow out of control, fanned by the region's Santa Ana winds. Now, in financial terms, that inherent environmental vulnerability is exacerbated by the fact that a large number of PG&E's customers live at what's called the wildlife-urban interface. They live in these forested areas. And many of these customers are very affluent. They live in very expensive homes. So that magnifies the potential losses. Now, unfortunately, in 2017 and 2018, when some of these wildfires broke out, on the second dimension, where we define physical risk, we learned that PG&E's mitigation measures perhaps weren't as effective as they ought to have been. But the decisive factor that shaped our decision to sell PG&E from the core infrastructure strategy arose from an esoteric legal doctrine enshrined in the Californian Constitution, a doctrine known as inverse condemnation. Now, in simple terms, inverse condemnation says that if a resident of California's property is damaged or they're deprived of that property by an action of the state, then they're entitled to recover just compensation from the state. Now, that's not particularly unusual. A number of US states implement this idea. But the manner in which Californian courts have interpreted this doctrine render it particularly dangerous to Californian utility investors. And there's two attributes that mean this is dangerous. The first is that the Californian courts have held that the doctrine of inverse condemnation is applied with the standard of strict liability. So that is without regard to whether or not the company was negligent or whether or not the loss suffered by the resident was foreseeable. The second and even more damaging consideration for utility investors is that the state has held, or the courts have held, that the doctrine applies to utilities, including, I might add, investor-owned utilities. They effectively assert that these are an instrumentality of the state. The implication of this is that where a fire is started by a utilities equipment, perhaps by vegetation contacting a power line, the state is strictly liable for any loss incurred by customers, regardless of whether or not they prudently maintain their network, managed vegetation, or whether that loss was even foreseeable. So in 2017 and 18, the wildfires in PG&E's service territory were devastating. You know, these fires consumed more than 10,000 homes and commercial structures, and tragically took the lives of more than 120 individuals. Now, as the scale of these fires emerged, estimates as to PG&E's prospective liability under the doctrine of inverse condemnation emerged at around $30 billion, many multiples of the company's insurance coverage. Now, concerned that those liabilities might lock PG&E out of capital markets and that they wouldn't be able to recover these costs sufficiently quickly, we took the decision to exit our position in PG&E in the core infrastructure strategy. Now, we took no joy in that decision. The stock months earlier had been trading at as high as $70 per share. We were able to exit at around $24.39 on average. So a heavy loss. But ultimately, that was the right decision because when the company subsequently entered Chapter 11 bankruptcy, its stock traded as low as $5 per share. Contrast the more recent fire involving Xcel Energy in the Texas Panhandle, where we bought more stock in the company's business. Now there are some superficial resemblances to PG&E's case. The environmental conditions in the Texas Panhandle get dry and arid during the winter and dry out the region's prairies and grasslands, which creates fuel for significant wildfires that can spread very quickly. Now, in February this year, that environmental vulnerability materialised into a real risk to cash flows when heavy winds knocked over an Xcel Energy power pole, sparking what's known as the Smokehouse Creek fire that ultimately consumed more than 1 million acres of land, destroyed nearly 140 structures, took the lives of 15,000 cattle and tragically 3 individuals. In response to this incident, on the 29th of February, when Xcel issued a press release noting that they'd received a letter from lawyers asserting that the company could be liable for damages in respect of the fire, the company's stock price fell dramatically, fell approximately 14% over the course of 2 trading sessions, wiping out $4.5 billion of market capitalisation. Now, those losses were exacerbated by a couple of broker notes that suggested that the company's liability for the incident could be as much as $7 billion US. Upon reading these notes, it quickly became apparent to us that this research was not particularly well reasoned or thoughtful. One of the estimates, for instance, sized the prospective liabilities by reference to a precedent fire in a different state where property prices are orders of magnitude larger than those in the Texas Panhandle. Another one sought to size the damage to pastoral lands by reference to their purchase price. But of course, these lands will rejuvenate, so the more appropriate measure of economic loss was an annual rental charge for a few years. So as we sought to size the loss of structures to cattle to various other forms of economic loss, it quickly became apparent to us that the $4.5 billion of losses that the market imputed were dramatically overstated. And our analysis suggested that the losses might well be fully covered by the company's $500 million of insurance coverage. Now, that analysis was broadly supported in the company's first quarter results when the company announced that their preliminary estimate of losses for the incident were $215 million, fully covered by their insurance coverage at this point. They might grow, but there's significant headroom on that $500 million of coverage at this stage. And so that prompted a partial re-rating in the company's stock, supporting our decision to increase our stake.
Thanks, David. I think that really demonstrates our really detailed approach in the infrastructure team after an incident. However, I just want to talk about what companies can do to mitigate against this risk. We see research, industry research coming out, for example, from the IPCC, which points to increased frequency and severity of these extreme weather events. So what can infrastructure companies do, or what do you look for in terms of mitigating against this damage?
Thanks, Amy. Mitigation can be a really powerful tool to secure the resilience of a utility's underlying cash flows and earnings. And we see this demonstrated profoundly involving one of our more recent investments in the core infrastructure strategy, a company called NextEra Energy. Now, NextEra Energy operates a utility business in Florida called Florida Power and Light. And of course, Florida is inherently vulnerable to severe hurricanes. So for the last 10 years or so, the company has been investing with the support of their regulators to secure the resilience of their network to these weather events. They have, for instance, invested to underground nearly 50% of their distribution infrastructure. They've replaced approximately 95% of their transmission towers with steel and concrete structures, replacing the legacy wooden structures. They've done things like lift their substation and generating infrastructure to avoid storm surges. Now, in 2022, these resilience strategies were put to the test when Hurricane Ian formed off the coast of Florida. Now, Hurricane Ian was the fifth most catastrophic hurricane to ever make landfall in the continental US. It bashed the coast with persistent winds in excess of 240 kilometres per hour. And what emerged throughout this incident was that the investments that NextEra had made over the course of a decade had dramatically improved the resilience of the company's network. Where in 2005, during a less severe storm, 100 transmission towers were knocked down, in this incident, not a single tower was knocked down. During the incident, every one of Florida Power and Light's conventional and nuclear generating plants remained online the entire time. Just 0.3% of the company's solar modules were damaged during the storm. And the company's underground distribution infrastructure performed approximately 50% better than its legacy overhead lines. Moreover, the company's installation of smart grid assets allowed the company to restore power at a record pace, with 2/3 of the 2.1 million customers who were experiencing outages as a result of the storm restored to power within 24 hours. So a very profound demonstration of the resilience that these investments can secure with a thoughtfully executed mitigation strategy.
Thanks, David. And I think it really shows what companies can do around resilience and adaptation, and that you really clearly pointed out how that can have a customer benefit as well.
Yeah.
Thanks for joining us today. I hope you enjoyed this really insightful discussion around extreme weather events and how the infrastructure team think about this in their investment decisions, but also what companies should be doing in terms of adaptation and resilience. If you've got any questions, please reach out to your Magellan distribution team and feel free to share this with any clients and colleagues.